Mysterious at the opening. Most traders don't lose money because their strategy is bad. They lose money because they never truly knew whether their strategy worked in the first place. That may sound uncomfortable, but it's the truth most retail traders avoid. They believe in a system because it felt right on demo, or because it worked for a few weeks in a trending market, or worse, because someone else said it was profitable. And then one day, when the market shifts slightly, that belief collapses along with the account. Here's the uncomfortable question most traders never ask themselves honestly. Do I actually know this system has an edge, or do I just hope it does? Hope is not a strategy. Confidence without evidence is not confidence. It's gambling dressed up as analysis. Backtesting is not exciting. It doesn't give you dopamine. It doesn't make you feel smart. But it does something far more important. It tells you the truth. And in trading, truth is the rarest asset of all. After more than 15 years in the markets, I've seen the same pattern repeat endlessly. Traders jump from one setup to another, tweaking indicators, adjusting rules, changing time frames, always searching for certainty. But they skip the one process that could have saved them years of pain: systematic backtesting. And the irony is brutal. Traders say they don't backtest because it takes too much time, yet they'll gladly spend years losing money instead. Early in my career, I was no different. I trusted systems because they looked clean on charts. I trusted them because they aligned with my bias. I trusted them because they made sense intellectually. But I didn't trust them because I had proof. I had beliefs. I had opinions. I didn't have data. And the market punished me for that ignorance again and again. Backtesting was the moment trading stopped being emotional and started becoming professional. It was the moment I stopped asking, "Will this trade win?" and started asking, "What does the distribution of outcomes look like over 100 trades?" That shift changes everything. Because trading is not about individual outcomes. It is about expectancy over time. And expectancy without backtesting is nothing more than fantasy. This video is not about how to backtest mechanically. It's about why backtesting is the only way to know whether a system deserves your trust. Not your hope, not your optimism, your trust. And once you understand that difference, you will never approach trading the same way again.
The most common mistake retail traders make with backtesting is not doing it at all. The second most common mistake is doing it incorrectly and believing the results anyway. Many traders think they're backtesting when they scroll left on a chart and visually confirm that a setup would have worked. That is not backtesting. That is hindsight bias pretending to be research. When you know what happens next, your brain subconsciously filters information to justify the trade. Losses disappear. Edge is exaggerated. Reality is distorted. Another mistake is testing too few trades. A system that wins 5 times in a row tells you almost nothing. Markets are probabilistic systems. Small samples lie. They always have. You can flip a coin 10 times and get 8 heads. That doesn't mean the coin is broken. It means your sample is meaningless. Then there's the most dangerous mistake of all: overfitting. Traders optimize a system until it perfectly explains the past. Every parameter is adjusted to maximize historical profit. The equity curve looks beautiful, smooth, almost artistic. And the moment the system goes live, it collapses. Why? Because the trader didn't discover an edge, they discovered noise. Markets change regimes. Volatility expands and contracts. Liquidity shifts. Participants change behavior. A system that only works under one exact set of historical conditions is not robust, it's fragile. And fragility in trading leads to rapid drawdown. The real pain comes later, after losses, after doubt sets in, after the trader starts questioning themselves rather than the system. Without proper backtesting, you don't know whether losses are part of normal variance or a sign the system is broken. So you interfere, you change rules mid-cycle, you abandon the system right before it recovers, you jump to the next idea and repeat the cycle. This is how traders stay stuck for years, not because they lack intelligence, but because they lack evidence. Backtesting, when done correctly, eliminates this confusion. It defines the boundaries of pain in advance. It tells you how bad things can get, how often losing streaks occur, and whether the system survives them. Without that knowledge, every drawdown feels like failure, and emotional decision-making follows. The market doesn't punish ignorance immediately. It punishes it eventually, and when it does so without mercy. The real revelation about backtesting is not that it predicts profits. It doesn't. Backtesting reveals risk. It shows you the distribution of outcomes you must be willing to tolerate in exchange for the edge you are chasing. And that is the part most traders are psychologically unprepared for. When you backtest a system properly, across different market conditions, sufficient sample size, and strict rule execution, you start to see patterns that are invisible in live trading. Long flat periods, sudden drawdowns, clusters of losses, and then, slowly, expectancy emerges. Not certainty, expectancy. This is where professional thinking begins. Professionals don't ask whether a strategy wins. They ask whether the payoff structure justifies the risk over time. They accept drawdowns as part of the business. They don't personalize losses because they already accounted for them statistically. This shift is profound. Once you know that a system historically survived a 20% drawdown and continued to perform, you don't panic at 10%. You don't change rules. You execute. Because you're no longer reacting emotionally, you're following a tested process. Backtesting also reveals something uncomfortable. Many strategies people love simply don't work, or they work so marginally that transaction costs and execution errors erase the edge entirely. This is not failure, this is clarity. Clarity saves capital. Clarity saves time. Clarity saves psychological energy. Backtesting is not about finding the perfect system. It's about eliminating the illusions that keep traders trapped. Once illusions are gone, progress becomes possible. And that is why backtesting is not optional. It is the price of entry for anyone who wants to trade seriously.
At its core, backtesting is not a technical exercise. It is a filtering mechanism. Its primary function is not to tell you how much money you can make, but to tell you whether a system deserves capital allocation at all. And this distinction separates retail thinking from professional thinking. Professional traders and funds do not start with conviction. They start with skepticism. Every strategy is assumed to be false until data proves otherwise. Backtesting is the process that moves a system from hypothesis to evidence. A trading system is nothing more than a set of rules interacting with market structure. That interaction produces outcomes. Those outcomes form a distribution. Backtesting reveals that distribution. This is where most retail traders misunderstand edge. Edge is not win rate. Edge is not accuracy. Edge is expectancy. Expectancy is a mathematical reality, not a feeling. It is the average outcome per trade over a sufficiently large sample. A system with a low win rate can be highly profitable if its winners outweigh its losers. A system with a high win rate can still fail if losses are catastrophic. Backtesting exposes this truth clearly and without mercy. Consider a simple case study. A trend-following system on a higher time-frame futures market shows a win rate of only 38%. On the surface, most traders would reject it immediately. But backtesting over 1,200 trades across multiple market regimes reveals a consistent expectancy because winners are 3 to 5 times larger than losers. Long losing streaks exist, drawdowns are real, but the system survives, and more importantly, it recovers. Now compare that to a scalping system with a 75% win rate. On paper, it looks superior, but backtesting reveals that occasional losses wipe out dozens of small gains. Transaction costs compress profits. Slippage destroys consistency. Over time, expectancy collapses. Without backtesting, both systems might feel equally convincing in live trading. With backtesting, their true nature becomes obvious. This is why smart money focuses on robustness, not perfection. Robust systems survive variation. They perform across different volatility regimes. They tolerate execution imperfections. They don't rely on precise entries or fragile conditions. Backtesting across multiple datasets and market environments reveals whether a system is robust or merely optimized for a specific slice of history. And this is where insider thinking diverges sharply from retail behavior. Retail traders search for confirmation. Smart money searches for disconfirmation. They actively try to break their own systems. They test worst-case scenarios. They assume future conditions will be harsher than the past. If a system cannot survive that stress, it is discarded, regardless of how good it looks on paper. Backtesting also defines psychological viability, which is rarely discussed but critically important. A system may be profitable, but if its drawdowns exceed the trader's emotional tolerance, it will never be executed consistently. Backtesting quantifies this in advance. It tells you whether you can trade the system, not whether the system works in theory. This alignment between system behavior and human behavior is where real edge emerges. When backtesting is done properly, it removes ego from the process. It replaces hope with evidence. It transforms trading from emotional decision-making into probabilistic execution. And that is why backtesting is not a technical step in trading. It is a philosophical commitment to truth over comfort.
Understanding the importance of backtesting means nothing if it doesn't change how you operate as a trader. The first practical shift is this: you stop asking whether a system feels right, and you start asking whether it has survived enough trades to earn your trust. That means defining rules clearly before testing begins. Entries, exits, position sizing, stop placement, everything must be unambiguous. If a rule can be interpreted differently in hindsight, it is not a rule, it is a narrative. The second shift is committing to sufficient sample size. A system that has not been tested across at least a few hundred trades, ideally spanning multiple market conditions, has not earned the right to be traded with meaningful capital. This is not about perfection, it is about statistical relevance. Small samples produce false confidence. Large samples produce uncomfortable truths, and those truths are precisely what you need. The third shift is separating testing from optimization. Backtesting should first answer a single question: does an edge exist at all? Only after that is confirmed does optimization become relevant. Most traders reverse this process. They optimize first, then convince themselves an edge exists. Professionals do the opposite. They prove edge first, then ask how to express it more efficiently without destroying robustness. The fourth shift is using backtesting to define risk, not profits. Before placing a single live trade, you should already know the worst historical drawdown, the longest losing streak, and the volatility of returns. These metrics tell you how much capital to allocate and whether the system fits your psychological profile. If you cannot tolerate the worst historical outcomes emotionally or financially, you should not trade the system, regardless of how attractive the returns appear. Finally, backtesting must be treated as an ongoing process, not a one-time validation. Markets evolve, edges decay. Periodic retesting ensures that what once worked has not quietly stopped working. This is not about chasing new systems. It is about maintaining alignment between strategy and market reality. Backtesting applied this way becomes a decision filter. It tells you where not to trade, where to reduce risk, and when to step aside. That alone puts you ahead of the majority of retail participants. The hardest truth in trading is also the simplest. The market does not reward belief, it rewards preparation. Backtesting is the act of choosing preparation over hope. It is how you earn confidence instead of borrowing it from recent wins or other people's opinions. It is how trading stops being personal and starts becoming professional. If you are trading a system you have not properly backtested, you are not managing risk, you are outsourcing it to randomness, and randomness always collects its fee eventually. The traders who survive long enough to succeed are not the ones with the most creative ideas. They are the ones who are willing to confront uncomfortable data and accept what it reveals. They don't chase certainty, they build processes that function without it. If this video challenged how you think about your own system, that is intentional. Growth in trading rarely feels reassuring at first, it feels clarifying. If you want to continue learning how professional traders evaluate systems, manage risk, and think in probabilities rather than emotions, subscribe to Staro Trading. This channel exists to replace myths with structure and hope with evidence. And before you move on, ask yourself one honest question. Do I know my system works, or have I just been trusting it?